Moonlight Real Estate Syndication Show. I am your host, Eric Lindsay. Here at Moonlight, we choose to focus on achieving financial security through real estate. And today we are here with Hayato Hori. Hayato is an owner and managing partner at Red Brick Equity, a company with a mission to acquire affordable, income producing multifamily real estate deals for passive investors. He brings a strong background in off-market residential investing through his role as founder of Rocket Offer, and which was featured in Business Insider and also Yahoo. Without further ado, welcome to the show, Hayato.
Thank you so much for having me, Eric. I appreciate that.
Yeah, it's truly our honor to be able to have you on. It sounds like you've been around for quite some time. You've had some success. You started off in the residential world, the wholesaling route, and also had some spotlights shined on you. So Business Insider and also Yahoo thought that it was a pretty good thing to interview you. And so it sounds like you've had a high level of success already, and now you're venturing into the multifamily arena and the syndication part of the real estate investing niche. And so we're definitely thrilled to be able to have you on the show, learn from you, and hear about your journey and even as of today, what it is that you guys are actually doing. So we're definitely in for a treat. And so, but before we get into those conversations, if you could share just a little bit more about yourself and also how you got started in real estate, that'd be great.
Yeah, absolutely. So I initially purchased my very first rental property right out of college, and I was 21, bought a property out in Memphis, Tennessee. I actually bought it from a friend of mine, my roommate actually at that time, and he was selling turnkey rental properties, and I bought one from him in Memphis, Tennessee. That's essentially where my first real estate investment came into, and that's where my journey began. And as soon as I bought that rental property, I got hooked. And I had a W-2 job back then. I was working at a company called Hyperloop Transportation Technologies. It was one of Elon Musk's idea to travel within a tube so that you can travel at the speed of sound. And I love that vision. I love the people I worked with there as well. But I always knew that I always wanted to do my own thing and had my own company. I started many different side projects and side hustles, as many people do in college. And I just love the fact that I got to pursue and put in 110% of my effort into a project that I truly believed in. And from there, when I got hooked into real estate, I decided, hey, you know what? I want to do real estate full time. I love this first rental property that I bought, but it was cash flowing $200 a month. I can't really survive off of it. And so I was looking at different ways that I could survive off being a real estate investor. And that's when I stumbled into wholesaling and selling off-market deals. And so 1 year after I bought my first rental property and I was working my W-2 job, I decided to leave. And from there on, decided to pursue wholesaling real estate. And fast forward 3, 4, 5 years from then, I was averaging maybe 10 to 15 deals a month. And I was selling to institutional investors and retail investors alike. And in that journey, I learned a ton. One of the biggest things that I've learned and look back on, which is why I have a real estate fund now, is I saw a company, an institutional fund that started purchasing properties out in the Midwest where I sold properties at. And I saw them start from nothing all the way up to owning $1 billion in assets and more in the 5 or 6 years that I was selling properties to them as well. And so I saw the power of how compounding each rental property that they were purchasing on a month-to-month basis really helped them grow and compound their efforts. Whereas I was kind of in a rat race on my own, where I would have to find the next 10 properties the next month and continue that on and on and on and on. And there was nothing compounding about what I was doing. I had employees that grew. I had expenses that grew as I did more deals, but my efforts in compounding the valuation of the business didn't go that way. And so that's when it really clicked for me, where having a property and having having your efforts compound by holding on to these properties are the biggest key to wealth. And that's really what I wanted to pursue. And now I own and manage Red Brick Equity with two of my other partners. And we are focused on acquiring multifamily deals in the Midwest.
All right, that's great. And so how many units have you guys acquired since you guys partnered up?
Yeah, so we began Red Brick Equity when we started the company beginning of this year. And so we just closed on a 26 unit building about a month ago, and we're closing on a 24 unit building in 2 weeks or so. And we're hoping to close on one or two more before the year ends. And so we're hoping to get around the 100 unit mark by the end of this year. But in 2 weeks or so, we'll be at the 50 unit mark.
Okay. Yeah, congratulations on that. That's an achievement. That's definitely a milestone. 26 units to go from being a wholesaler, doing 10 to 15 deals per month, which was great transactional funds and brought about some really good paychecks, but it just wasn't presenting you with that residual income and that passive income and that compounding effect in which real estate can actually reward you with over time. And so that's amazing that you were able to make that shift. I know personally, I have a similar story. I wasn't quite doing 10 to 15 deals per month. You definitely was doing some decent sized volume there, but I was somewhere close to 20 to 25 deals per year. And I was wholesaling. I was doing pretty good. I was making some really good transactional funds, but I wasn't capturing that compounding interest and that compounding effect that real estate offers. And so the lights came on for me after about 3 years of being involved in that. And I made the decision to incorporate wholesaling still, but syndicate, hold real estate, buy real estate, and hold on to it. And so that's pretty unique that you have a similar story there. If I could, let's go back a bit. And so you mentioned that this company that you were working with, that you watched them go from zero within a portfolio to holding over $1 billion in real estate. And so was that with single family residential properties or only, or was that with other asset classes as well?
That was purely single family. So I would sell, they were purchasing in maybe 4 or 5 different markets around the Midwest. And I was focused on the Midwest as well. I would maybe sell them a few deals on a per month basis here and there. And for me, I was thinking, wow, I'm making a good amount of money. They're paying me a good amount. This is great. I have a consistent investor purchasing my inventory on a monthly basis. What can be better than that? And then fast forward 5 years later, I look up where they were at and how much assets they've accumulated. And I saw the difference in my company 5 years from when I started. I saw their company 5 years from when they started. And it was just night and day. And really, that's when everything clicked for me, where I didn't need a whole piece of the pie. I just needed a sliver of the pie and grow together as a community, because you can really go so much farther with a community. And that's why I love the fund and syndication structure too, because people can actually come into these deals. They have ownership and they essentially partner with you while being 100% passive, and they still get all the upside on the deal. And so I think it's just a beautiful way for everyone to get involved, investors to come in on the deal. We don't get as big of a pie, we get a sliver of it, but we can compound our efforts through and through with a community. So that's why I love it.
Okay, and so you mentioned this fund that you guys are now operating. How did you guys go about structuring that? Because I've looked into a little bit of the fund model, and it seemed pretty pricey to get that going. What did you guys do to be able to structure that? And is there a cheap alternative for this?
Yeah, there's platforms out there. To start a fund, you typically need to spend anywhere between $50 to $100,000 on paperwork, legal work, structuring it correctly, making sure your PPM and everything is all structured correctly. And there are now platforms that are out there that help you provide these subscription docs and then structure the fund and whatnot. There's many out there if you look them up, but what I will say is the hardest part was us structuring and making sure that the investors, when they do come through, because we wanted to make sure it was modernized as well. So when people come in, they have a portal that they can log into, see all the updates from there, see our new opportunities, sign the documents within it. So we wanted to make sure that everything was completed within that platform too. So we looked at many different ones and ultimately decided on one. And we also wanted to make sure that if we wanted to have an open-ended fund or closed-ended fund, we could actually transition in and out of those too. And so that's kind of how we structured it with our fund. But there's no, right way or one way to do it. I think there's many different ways, but that's ultimately how we decided to go about it.
And so annually, is there any fees that need to be maintained or that's ongoing with operating a fund?
Yeah. There is software fees that we are constantly paying for our portal to be live. As far as other monthly costs, there are costs to analyze deals and fly out to these properties. And we're always creating a new pipeline of deals. As syndicators and as fund managers, that's one of the most important things, is to have these pipeline of deals continuously coming to you. So that way, whenever you have the capital ready, you can always pull the trigger on one that actually makes sense, because speed is the name of the game in real estate. If you're not able to jump on a great deal, then that deal is going to go inevitably to someone else. So we always want to make sure that we have that pipeline hot and ready, but also have the capital ready. So it's kind of like two boats or two parts of the boat that you're always managing and making sure that it stays balanced.
Yeah, that's 100% correct. If you don't have the capital ready to go, it could easily get swiped up by another investor that does. And so there's a saying that's often said that time kills deals. And so if you can't move quickly, sometimes you can miss out on a great opportunity. And so I know within the commercial world, things move a little bit slower than that, but you still want to be able to have funds readily available rather than having to go through a major raise and not be sure if you're going to be able to get the deal to the finish line. So I think that's a great strategy that you guys are using. Hayato, if we could, I like to stay chronological and keep the audience in gear. If we can venture all the way back to the beginning, a lot of the listeners that follow me, they're in the beginner stages of their real estate journey, high income earning W-2 professionals, business owners looking to invest passively or actively within real estate on the side. And so many of those individuals, they're just getting started. And so I try to provide value to them. If you could share with us, what was the first steps that you took when you made the decision that you were going to take the plunge into real estate? I know you bought a property from your friend and then got bit by the bug, so to speak. What steps did you take after that to make sure that you was going to have a successful investing career?
Yeah, the number one thing was I tried to learn about all the different type of loan programs out there and loan types, so that I knew exactly how much capital I needed in order to invest in a property. So whether it's single family or multifamily, multifamily have different loan products. And so you definitely want to understand what those loan products are and what that looks like. And that way you'll know exactly what you can get financed for, what you're eligible for, and how much, again, capital you would need. And you don't necessarily need all that capital on your own. You can always borrow it from a partner, bring in a capital partner to purchase the property. So there's many different ways to go about it. But I think the number one thing is just understanding the different types of loan products out there, so you know what you can get into. The second thing is obviously underwriting. You want to make sure that your analysis on these properties are accurate and that you understand what you're going into, because I always say it to everyone, don't go into anything that you don't understand. You want to make sure that you understand whatever it is that you're going into, whether it's single family, whether it's multifamily. You want to be able to 100% be confident into whatever you're investing into, because it's your hard-earned money. You don't want to make that go away. So that's the second thing. The third part of it is then building out a great team or network. And what I mean by that is making sure that when you do get that asset, you have a great team that can help you manage it, do the construction if you need to, make sure that you can manage that property. If you're going to place a property management company, if you're managing it yourself, you need to learn from other people on how to manage that. And maybe you build a team or advisors around you to show you exactly how to do so. That team is going to be extremely important and will determine how well your asset performs. So that would be the third part I would suggest everyone go into, whether it's single family or multifamily.
Yeah, you're always going to have to get educated initially, and that's exactly what you did. Understood exactly what you were up against as far as buying power and loans that were out there, underwriting, being able to make sure that you understand what it is that you were working with, and then also having a solid team is definitely going to get you further faster when you do have a solid team. You also mentioned that you decided to burn the boats. You exited your day job after a year of investing in real estate. Can you share with us what your thought process with that was? It sounds like you were pretty young at that point in time, so you didn't have a ton of overhead, and so I can understand that. I think that's more of a reasonable time if you're going to burn the boats to do it when the overhead is a lot lighter and you don't have so many people depending on you. But if you could share with the audience exactly what was going along with your frame of thought there.
Yeah, to be quite frank, I wasn't really thinking much. I was 23 at that time, and I decided, hey, you know what? I don't have any responsibilities at the moment. If it's ever a time, and if I ever want to take a chance on my own, I'd rather take it right now when I don't have kids and responsibilities. This is the time to do it. And so I didn't, I mean, that one rental property was all the assets I had. I really had no other assets at that time. And so for me, the way I thought about it is what could be worse? You know, what's the worst that could happen? I could lose my property and then I start from zero. I have to go find another job. Okay, that's my worst case scenario. That didn't seem scary to me. So that's why I decided, hey, you know what? That's the worst case scenario. I'm just going to dive in. I'll figure this out. And if I'm able to figure this out, the upside is way bigger than me staying. And so that's when I decided to take that leap.
Okay. Yeah, well, I mean, 23 years old, that is a reasonable time to do some experimenting. I listen to Gary Vee quite a bit, and he's a huge advocate of experimenting while you're young. And I completely get his premise with that. It's, you don't have a whole lot of baggage, so I think that's the time to do it if you're going to do it. But I promote a lot of times that safety net and just kind of building things up on the side and transitioning once you got a runway. But hey, everyone's path is going to be a little bit different, and it is definitely working for you. And so you've seen a group build out a massive single family portfolio. What made you go towards multifamily if you saw this working so well with them in the Midwest through a fund model? What made you gravitate towards multifamily?
Yeah, so I sold some multifamily as well while operating Rocket Offer too. And every time I would underwrite those deals, the unit metrics on multifamily just made a lot more sense for me. So what I mean by that is with the single family homes, with these operators and investors that were buying properties, there's nothing wrong with it. I think they're doing an amazing job. And with technology now, you can definitely manage these single family home portfolios way better than you could previously. What I love about the multifamily side of thing is when you buy 100 units under one building, you still only have one roof to take care of. You might have maybe a few boilers here and there. You have four walls. Sometimes the structure is different, but you might have 10 exterior walls. But when you're managing 100 properties, 100 single family homes as a portfolio, now you have 100 roofs, 100 HVAC systems, 100 hot water tanks, and 100 boiler. And so all these things accumulate and compound significantly when it's single family homes. And so for me, I'd prefer to have all that under just one building and grow it, the economies of scale just make it that much easier too. And doing transactions, because I was doing 10 to 15 transactions on a monthly basis with the single family home things and also some multifamily as well. I just know how difficult it is to continuously do those transactions on a month to month to month basis. And for me, it was way easier to go into a multifamily where we can identify 26 units and do that transaction in one quarter and identify another one the next quarter after that. And the scale of economy just was way better for me. So that's why we decided ultimately jump into the multifamily side of things.
That was my motivation as well. Have everything under one roof instead of having things so spread out, because property management is going to be an issue. If you get a great third party property management company that can manage single family well, they solve a lot of the issues there, but it's still better to have everything under one roof, or maybe 2, 3, 4, 6 roofs rather than 50 or 100 individual properties. It just kind of works out a little bit better. Hey, before we go a little bit further in the show, what would be your recommendation right now for a person that may be at a crossroads considering either burning the boats and going all in on real estate, or building it up on the side and keeping their primary W-2 income or their main business as the main source of income? What type of recommendations would you give to someone as of today?
Yeah, if I had to give myself feedback when I did jump boat, I would say have more cash reserves, because real estate is cash intensive. And so if you don't have that cash and you're planning to do everything on your own, then you'd better have a great capital partner to help you fund those projects, because renovations will go over budget and there will be capex items that will come up. There are repair maintenances that come up. And so all these unknown and unforeseen things can happen in real estate, and they're not small numbers. They're going to be quite large. And so to protect yourself, having a larger having more capital in your bank is always going to be helpful. So I would make sure to have that before jumping ship or anything of that nature. And then while you have your job, if you really do want to go into real estate investing and haven't done so yet, I would honestly invest in real estate while you're in that job to see if you even like it. Whether it's through buying your own single family home portfolio, or maybe starting with one single family rental, or maybe investing in a syndication if you want to be 100% passive and want to learn how things go with multifamily and how these assets produce income, and just learn as you get these distributions. Whatever it is, I think you should just dabble in it first while you do have your W-2 income job, just so that you understand how the process works. And even if you like it, great, then you can make your decision. But if not, some people might say, hey, I hate real estate. I don't like managing real estate. I don't like the maintenance side of things, and I don't ever want to deal with it. Then you can try different avenues like syndications so you can be 100% passive. But if you don't even like that, then maybe real estate is not for you too. So doesn't mean that real estate is for everyone. It's just something that you should determine on your own and figure out whether this is something you want to continue pursuing. And the only way you would really know is if you actually place some of your dollars into it, because sometimes people just analyze and underwrite too long and think about things too long and never take action. And that honestly might affect you even more so than just taking action and losing some initial funds if that ever happens.
Yeah, those are both great suggestions, to have a longer runway or having more capital on the side, because just like you said, renovations, reserves, those are big numbers, into the tens of thousands of dollars, depending on what type of projects you're getting into. And so if you've got a good surplus of cash, that's that much better, or further of a runway that you can have as you move forward. So great suggestions on that. And so if we can bring things up to more current events. You guys are looking into acquiring multifamily assets now. Kind of shine the light on exactly what it is that you guys are seeing within the market. We all know what took place in 2022. The Fed began to increase interest rates, and sellers didn't really adjust their pricing much, and it just kind of was a bad recipe. And so How are you guys navigating those waters and still acquiring as of 2025?
Yeah, so we've been in the Midwest market since the beginning. That's where we're currently purchasing multifamily as well, namely Chicago. I live and reside in Miami, Florida at the moment, and we were doing deals in the Midwest previously. I was in California. So I've never done a deal in California. I haven't done a deal in Florida either. It's just we haven't been able to pencil out deals in those markets. And so with the Midwest, it's a little bit less volatile. Everything has been quite steady, especially, for example, in Chicago. It's the third largest populated city in the US. Tons of strong economics there, job diversity there. So we're very bullish on the Chicago market, and we think it's going to continue going up. Maybe not as high as it has in Texas or Florida in the past few years, but it's been steadily and gradually growing, and we think it will continue to do so. And we don't see an oversupply in markets like Chicago as we've seen in Texas and Florida. For example, we've seen a ton of new developments come up here in Florida. There's a ton of rent concessions being available to tenants at the moment here. And I think it's the same in Dallas, Houston, Texas as well. And so that has kind of plateaued. The rent even have come down a little bit too in some of the areas in Texas as well, from what I've seen. And so with Chicago being quite populous and not many new developments going on, the assets have been relatively stable. So those are the places that we like to be in B and C class locations.
Of course, there's so many thought leaders that they just share this cookie cutter approach as to stay away from blue states, stay away from blue cities. How are you guys navigating those waters with the tenant laws being a little bit more friendly towards the tenants? Has that been an issue with you guys in Chicago?
We hear that a lot, like, oh, I never invest in blue states or red states. We always look at it from a number perspective and weigh out the pros and cons of each of these places that we own real estate in. So, for example, like California and New York, those are blue states. They have rent control and they're very strict with evictions and whatnot. Chicago doesn't have rent control, so that's very helpful. But they do obviously have stricter eviction requirements than red states too. But another thing to always consider as well with some of these red states is, again, I live in Florida. There's no income state tax here, but the state needs to make money elsewhere. And so a lot of times they do so through property taxes. And I know Florida is talking and discussing about maybe even getting rid of property tax. I don't know if that's going to happen, but you see it a lot in Texas, for example, where property taxes, especially for single family homes, have gone throughout the roof. And they're even with rent growth and even with appreciation that has happened in Texas, it's quite hard to pencil deals out there from a cash flow perspective because of how high the property taxes have gone. And so those are some things that we always weigh in and out as well. And also blue states, we like affordable housing and we like placing Section 8 tenants in properties and providing them with units and places that they can be proud to call home. And for them, we see that blue states offer them a lot of opportunities, and we see that the funding for those are typically higher as well. And so we see a massive wait list. We see that the Section 8 rents are higher sometimes than market rents as well in these cities and states as well. So, for example, Chicago, CHA, the Chicago Housing Authority, typically pays slightly higher than what the market rents go for to place these tenants in because they want to make sure that these affordable units are out there and they're able to also place these Section 8 tenants in there because they're blue state and they're more tenant friendly. And so these are all the different types of benefits that you get from blue states. So whether it's a blue state or a red state, for us, again, we just like to weigh out the pros and cons. We'll never say no just because it's a red state or just because it's a blue state. We like to take a look at everything that the city and state has to offer. And from there, we determine whether we actually want to go into that state or not, if that makes sense.
And so, what are you guys doing to offset the longer periods that it will take potentially to evict a person? Is there some type of metric? Do you guys just figure on a 85% occupancy rate to somewhat safeguard yourself, or as one of the assumptions? How do you guys navigate that?
Yeah, number one, the screaming of tenants are very vigorous. That's the most important thing. The other thing is, yes, we do account for a higher vacancy and delinquency and losses from the net rent, from the initial rent that we would collect. So many markets, you would underwrite vacancy for maybe 5%. We account for maybe 7 to 10% so that we can account for some of those losses that could potentially come in. And so given that, we always add a cushion. I like to be very, very conservative with the numbers in our underwriting. So as long as we can underwrite for it and it still pencils out, then we're happy to go through it.
Okay, that's amazing. Yeah, I think a lot of guys they're overlooking great opportunities all because of a coach or some mastermind leader or some talking thought leader that just shares this cookie cutter approach. Don't ever buy in a blue state. And we're looking at a deal right now in California, and it's a hotel conversion into multifamily, and we've got a great, solid boots on the ground person. We're gonna operate it almost like a development. It's gonna come 100% vacant, and so we don't have to worry about tenants at that point. We're gonna come in, we're gonna perform a rehab, and then get it all leased up and exit within 3 years or something to that effect. And so there's ways to get around that as long as you can create a business plan that's solid. You can actually or absolutely buy properties within blue states. And so yeah, you guys are doing a great
Absolutely.
job.
Yeah, I tell everyone you can make money in any city or state. Like, look how many millionaires have been made in New York and California. And these are the bluest states you can get to. And just because it's a blue or red doesn't mean that you can't make money. You can make money in any given state, in my opinion.
Very true. Very true. Okay. Well, I mentioned to you before we actually went live that I'd like you to share a recent transaction that you guys have been a part of. If you could just share it at a high level, how you guys went about locating it, how you funded it, some interesting details about the business plan, how you executed it. Just give us some general information.
Yeah, we closed on a 26 unit building in Chicago just about a month ago. And this building we found through one of our broker relationships and networks. And so right before it got listed, we actually got the property sent over to us. We liked it. We made an offer and decided to pursue the deal. 26 units. We bought it for $2.7 million out in Chicago. I know in some areas, 26 units for $2.7 million sounds insane. But that's what we got it for. And we purchased it in an area, southern parts of Chicago. It's near where we call Beverly in Chicago, just around 10-minute drive from there. And we love that area and we think it's going to continue to go up.
Okay, great. And so that is, what is that, roughly about 100,000 per unit, or where are we at on cost per unit? Is that pretty accurate there?
Yeah, just around 100K per unit.
Okay, and so what are you guys able to get for rents there? Just curious with Section 8.
Yeah, so on average, our two bedrooms there are getting around $1,550, $1,600 per month in rent. And for the three bedrooms, we're seeing around $1,750 to $1,800. But our max rent on each of those units, for the two bedrooms, the max rent that we're getting is closer to $1,780 or so. And then for the three bedrooms, it's all the way up to $2,300. So we can push those rents up more, but we've underwritten conservatively on what we think is realistic and what we can hit on average.
Okay, and what type of metrics do you guys go after on average? What are you guys aiming for? Because that sounds like that's absolutely hitting the 1% room and better than that. So, what do you guys go after when you guys are targeting your metrics?
Yeah, we like to look at buildings that are 20 to 100 units, and we do so for many reasons, which I can go into a little bit more. But 20 to 100 units. For our investors, we like to make sure that they can get a minimum of 15% IRR conservatively. And so that's what we like to underwrite for. And for everything else, as long as it pencils out to those numbers, we will make an offer and move forward with it.
Now, with Section 8, is there any lending constraints that comes with that? Because I was told that, especially when it comes to like STR, midterm rental, there can only be a certain percentage within a property that lending, or at least when it comes to Fannie and Freddie debt, that they'll accept. So when it comes to Section 8 there, what's the lending constraints when it comes to percentage of units that can be Section 8?
Yeah, Freddie and Fannie doesn't care if it's 100% Section 8 tenants. We go through agency lenders, Fannie and Freddie, every time as well. That's why we also like to have the buildings that are 90% plus occupied, because that's what the agency loans require us to have before going into it. So the building has to be 90% plus occupied by the time you purchase it, and they need to show that for the last 3 months. Freddie and Fannie also has many other requirements for us too. They need to see our sponsorship track record, make sure that we bought similar buildings to this prior and have the experience to do so. Our net worth liquidity has to be over the loan amount, and then we can only look at buildings that have $1 million minimum in loan amounts too. So those are all the requirements that these agency loans have. And so, but we love going that route just because we're able to get the lowest interest rates, it's non-recourse, and there's a lot more added benefits to it as well.
Okay. And as far as improvements, are you guys just bringing it up to market standards, or are you doing a touch better than market?
Yeah, we're doing it just slightly above market, I would say. That's our bread and butter for our property management company. And the reason they like to do it slightly above is Section 8 tenants also want to have a great unit. And so if they're going to bring their voucher to a unit, they want to bring it to the best unit around town. And so for us, we want to then, that's why we make sure that the units look a little bit nicer and they're done a little bit better than some of the comped properties. So that way we can get these tenants coming in, and Section 8 tenants stay typically longer than cash tenants. And so that works out great for us because we don't have to incur as much unit turnover costs as we otherwise might have.
Okay, great. And so Chicago is known for a lot of things, but one of the things that is known for is this high crime presence there. What are you guys doing to make sure that you're buying outside of that, or are you guys buying within that high crime area?
No, we're not buying in those high crime areas. We stay away from that. We don't go into D-class war zones, as we call them, and we don't go into A-class locations as well, because typically those properties don't cash flow. So B and C-class is always where we've been at, no matter what. And I know Chicago has that connotation, hey, it's a dangerous city. And so was Detroit as well, but we bought tons of properties out of Detroit. And I have single family homes still in Detroit that is cash flowing great, and the rents are great in Detroit as well. And I think a lot of times it's just the negative connotation that a lot of people have and the perspective they have without actually seeing that city. So we fly out, and we flew to Chicago, drove around pretty much every neighborhood that we can. And before we purchase every building, we like to go in and drive at least a few mile radius around the entire block to see what's changing, what's coming up. Are there new developments being installed? Is money being poured into the roads here by the city? Are there changes being made, or is this going to stay the same for the next 5 years? And we want to make sure that that area has the opportunity to actually grow in the next 5 or so years, because that's when we are looking to exit on the deal too. And so we want to make sure that these appreciation can happen. And those are the areas and pockets that we like to go into. So if there's nothing being done in that area, then we don't go into it, because we don't just take a look at the cash flow. We also want to make sure that there is some appreciation play there. Not as strong as A-class locations, of course, but at least some appreciation helping us push our backs a little bit.
Excellent job, Hayato. It sounds like you guys are doing an amazing job and have found a really unique niche within blue cities and blue states. And so, I think you guys are doing great. Hey, we're going to shift gears and start wrapping things up. But before we do, we always like to take our guests through our coaching round. And we have about 4 questions that we like to ask. If you could hold your response to between 1 to 2 minutes per question, that'd be great. The first question I have for you is, what do you think every new real estate investor should know before investing in real estate syndications?
I think they need to know how to analyze deals and how to read some of the underwriting that is presented to them on the offering memorandums. So knowing what an equity multiple is, what an IRR is, what the ROI is, and what the difference between those are, reading pro formas. I think those understandings will help you be a better investor and also allow you to get into better deals and also really speak with the sponsors of those projects, because the number one thing is trust. There's so many sponsors and deals out there, and you can decide to pick whichever one. If you're going to go into one, make sure you trust the person that you go into it with, because that's the most important thing.
Yeah, that's very true. Next question. Knowing what you know now, what kind of advice would you give a person attempting to get where you are within their real estate journey about balancing business and life?
Yeah, that's a great question. Initially, I don't think I actually had a balance, and I don't think you can get balance when you are trying to create something new. So, whenever you start a new business or whenever you're trying to scale a business, I think you have to pick your priorities on what that's going to look like. And then eventually it could balance out into something else depending on what point of life you're in. For me, the most important thing is knowing what that goal is, what you're willing to sacrifice for it, and then working hard enough and learning, continuously learning and learning from other people who are above you to really be able to get to where you want to be. And then you can always create that balance and pull back eventually later on. But initially, if you really do want to accomplish things, I think you just have to take action and jump in it.
Yeah, very true. If a person had minimal amounts of time, no money or experience, but they wanted to start and scale a business like yours, what would you recommend for them to do?
I think there are maybe 2 ways to go about it. One is just jumping right in and then learning from doing. I think that's how a lot of people learn. That's how I learned. There's another way to do it, though, which is learning from someone who has been doing it but needs a little bit of help. And so being the second right hand person and learning from exactly what they're doing and what their ventures are and being able to duplicate that eventually later on is another great path. And I've seen a lot of people be very successful there and also mitigate some mistakes that you might have gone through by going that route. So if you do, and if you can find someone that like that, I would highly recommend doing so. But just make sure you have something of value to give to them, because a lot of times people say, hey, I want to learn this, but they never have anything to actually provide value for. So make sure you have something to provide them with. And then that way it's beneficial for both parties.
Yeah, investors are far too busy just to deal with everyone that shows up and wants to join the team. So you definitely need to bring something to the table. Hayato, the last question I have for you is, what are the best reasons to invest in real estate as a passive investor?
I am a massive believer in real estate. I grew up in Singapore, and so I've seen millionaires be created through real estate. And so for me, I know that real estate is a tangible asset that's here to stay no matter what. And as the population of the world continues to grow and as our population continues to live longer with improvements in medication and healthcare, I think that housing is going to be the most important part of the economy. And for that reason, I think everyone should be invested into real estate one way or another. I know initially I said, go into real estate, see if you like it. But personally, if I were to be biased, I would say everyone should have a piece of real estate, because that's just something that no one can take away.
Yeah, just like the stock market, the employers, they funnel every one of their employees towards the stock market. I think they ought to give some education towards alternative investments similar to real estate, because it's performed just as well. And so I'm not knocking stocks or anything like that, but real estate is a great investment vehicle as well. And so I'm with you. I think everyone should pay some attention and have some portion of their retirement vehicle placed within real estate. So great answers to each one of those questions. Before we let you go, if you could share a great personal development book or a great business book with the Moonlight audience, that'd be great.
I actually have two. One is How to Win Friends and Influence People by Dale Carnegie. I think that's one of the most influential books that I've read. And it just helps build character and determines and it shows you how you can become a better person and better leader. And so I think that's really, really important whether you start a business or not. The second one is if you purely want something that's just business related, any one of Alex Hormozi's $100 million books is amazing. I've read through $100 million leads, $100 million offers many, many times and learned so much from him, and he gives it all away for free. So just a big shout out to him. I've learned a ton from those two books.
Yeah, both of those books are absolute game changers. And Alex Hormozi, he's an amazing entrepreneur. He shares insights. He gives away some really insider type of information that most coaching programs would charge you to be given away. And if you follow him, you can pick up a lot of those techniques and that information for 100% free. So I think he's a great guy as well. Hey, Hayato, we want to thank you for coming on to the show. You've been a wealth of knowledge. You shared your early beginnings as to how you got started in wholesaling and eventually burned the boats and now have transitioned into multifamily real estate investing. If someone listening to this show decided that they wanted to reach out and learn a little bit more about you, what would be the best way for them to be able to do so?
Yeah, my email's open. They can email me at hayato@redbrickequity.com, or you can follow me on social media. I'm on TikTok and Instagram. My handle is HAYANTOOO, Hayato. So if they ever wanted to reach out, feel free to do so.
Okay. Well, once again, Hayato, we appreciate you coming by today and sharing all that insight. We'd love to have you back anytime.
Thank you, Eric.